Today, I'm going to walk through a conversation I had recently with Alan and Jessica. Their goal is simple. They want to know exactly how much money they need saved if they want to spend $10,000, $15,000, or $20,000 per month in retirement after taxes. Hi, I'm Josh Palmer, Director of Financial Planning with the Noble Group. Let's start with learning a little bit more about Alan and Jessica. They're both 60 years old and plan to retire at 65. Now they have substantial savings, but we'll need to look at their guaranteed income in retirement to firmly nail down exactly how much they'll need saved at each spending level. They don't have any pensions and they don't have any annuities, so their only source of guaranteed income will be Social Security. Their full retirement age for Social Security is 67. Now, if they wait until that age to claim benefits, Alan will receive approximately $3,500 per month and Jessica will receive approximately $2,500 per month. Together, that's about $6,000 per month of guaranteed income before taxes. For today's analysis, we're assuming a portfolio return that outpaces inflation over time and a retirement lasting from age 65 through age 90. Before we jumped into the calculations, I mentioned to Alan and Jessica that we'd need to look at taxes on Social Security at each spending level as part of the calculation. Alan stopped me and asked a question I hear all the time. He said, "Josh, I thought Social Security was tax-free." The reality is that Social Security is often taxed, especially for retirees who have accumulated meaningful retirement savings. The IRS uses something called provisional income to determine how much of your Social Security benefit becomes taxable. Provisional income includes your adjusted gross income, certain tax-exempt income sources, and 1/2 of the Social Security benefit itself. Once that number exceeds specific thresholds, up to 85% of your Social Security benefit can be included in your taxable income calculations. Now that doesn't mean 85% of your Social Security disappears to taxes. It simply means up to 85% of the benefit is counted when calculating your taxable income. For many retirees who are withdrawing from IRAs and 401ks, they cross that threshold relatively quickly. That's why tax planning and Social Security planning cannot be separated. In Alan and Jessica's case, every spending level we are going to examine requires enough portfolio withdrawals that they will remain in the highest Social Security taxation category throughout retirement. Let's start with a retirement spending goal of $10,000 per month after taxes. When Alan and Jessica first looked at this scenario, their instinct was to claim Social Security immediately at age 65. If they do, their combined benefit drops to roughly $5,160 per month. After taxes, they are left with approximately $4,721 per month of spendable income. The portfolio must generate the remaining income needed to reach their goal. When we run the numbers, they need approximately $1.08 million saved at retirement. At this point, Alan looked at me and said, "Wait a minute. You're telling me we need over $1 million even with Social Security helping us?" I told him yes, but then I showed him something interesting. What if they delay Social Security until age 67? Under this strategy, often called Social Security bridging, the portfolio funds their entire lifestyle for the first 2 years. At age 67, their full Social Security benefit begins. Because that future guaranteed income is larger, the amount of money they need saved at retirement actually falls to approximately $1.04 million. Alan immediately noticed something that seemed counterintuitive. They are spending more from the portfolio early on, yet they need less money overall. The reason is simple. The larger Social Security benefit reduces pressure on the portfolio for the remaining 23 years of retirement. That larger guaranteed check keeps working for them every single month. So Jessica asked the obvious follow-up question. If waiting until 67 helps, what happens if we wait until 70? Now we're talking about fully maximizing delayed retirement credits. The portfolio carries more of the burden for 5 years, but the Social Security check becomes substantially larger. The required portfolio drops again down to roughly $1.02 million. This is one of the biggest retirement planning lessons people miss. Social Security isn't just an income source, it's an asset. And sometimes optimizing that asset creates far more value than chasing another percentage point of investment return. Now, let's move to a spending goal of $15,000 per month after taxes. This lifestyle typically includes extensive travel, larger healthcare reserves, more discretionary spending, and often helping children or grandchildren financially. And at this level, the importance of proper planning becomes even greater. If Alan and Jessica claim Social Security at 65, they need approximately $2.27 million saved. Waiting until age 67 lowers that figure to approximately $2.19 million, and waiting until age 70 reduces it again to roughly $2.13 million. Compared to claiming early, simply delaying their benefits saves them about $140,000 in required retirement assets. Notice something important here. The higher the spending goal becomes, the more valuable guaranteed income becomes. Every additional dollar coming from Social Security is one less dollar that must be withdrawn from investments during a market downturn. This leads us to another critical retirement risk known as sequence of returns risk. Many retirees focus entirely on average returns. However, the order in which those returns occur can matter just as much. If the stock market experiences a major decline during the first few years of your retirement while you're making large withdrawals, the damage can be incredibly difficult to recover from. Larger guaranteed income sources like Social Security help reduce this risk. Why? Because fewer dollars need to come out of your portfolio when the markets are struggling. So does this mean it's better then to take Social Security as soon as possible to hedge against this risk? Not necessarily. It's very dependent on the market conditions at the time you retire and the rest of your financial outlook. To get more clarity on this, I'll show you how to get a free retirement review from us at the end of the video, so be sure to stick around. Now let's dream a little bigger. What if Alan and Jessica want to spend $20,000 per month after taxes? This may represent significant travel, charitable giving, supporting family members, vacation properties, or simply maintaining a higher standard of living. Now, at this level of spending, Social Security is also making up a smaller amount of that monthly total. So Alan asked me, at this level, are we basically dependent on the stock market? The answer is no. In fact, this is where Social Security becomes even more valuable. If they claim at age 65, they need approximately $3.6 million saved. Waiting until age 67 lowers that target to approximately $3.51 million, and waiting until age 70 lowers the requirement even further to approximately $3.42 million. That single decision reduces the required portfolio by roughly $180,000. And there's another benefit many people overlook. When one spouse passes away, the surviving spouse generally keeps the larger of the two Social Security benefits. By maximizing benefits during your lifetime, couples are often creating vital financial security for the surviving spouse later in retirement. My colleague Jared goes into much greater detail on survivor benefits in this video, and it's worth a watch for every couple thinking about their Social Security decision. Because in many cases, delaying Social Security isn't just about maximizing your income today, it's about protecting your spouse if you pass away first. At this point, Alan asked me a question I hear all the time. What's the biggest mistake people make when it comes to finances in retirement? My answer may be surprising. The biggest mistake usually isn't saving too little or retiring at the wrong time. It's making decisions in isolation. People look at investments separately from taxes. They look at taxes separately from Social Security. And they look at Social Security separately from income planning. Retirement just doesn't work that way. Every single decision affects every other decision. The families who retire most successfully don't always have the largest portfolios. They have the most coordinated plans. They understand where income will come from, how taxes will affect their cash flow, when to claim Social Security, and exactly how much risk they need to take with their investments. So what can we learn from Alan and Jessica's retirement plan? First, delaying Social Security can actually reduce the amount of money you need saved before retirement day. Second, guaranteed income reduces portfolio risk and can help safeguard you against market volatility. Third, tax planning matters just as much as investment performance. Traditional IRA and 401k withdrawals increase your provisional income, which can increase the taxation of your Social Security benefits. But Roth withdrawals work differently. Qualified Roth distributions generally do not increase your provisional income, making them an extremely valuable planning tool. The reality is that retirement isn't about reaching some magical generic number. It's about coordinating your investments, your taxes, your withdrawal strategies, and your Social Security decisions into one cohesive plan. The difference between claiming Social Security at 65 and 70 was worth as much as $180,000 in today's examples. That is the power of thoughtful planning. So if you're within 5 to 10 years of retirement and you're trying to figure out what your number really is, don't rely on a generic rule of thumb. Build a plan. Understand your options. Run the math. The decisions you can make today could dramatically impact your retirement for decades to come. To start building that roadmap, click the link in the description or scan the QR code. We'll take a look at your unique financial situation so you can have a personalized, actionable recommendation. We'll talk to you soon.